Hi, everybody. Welcome to the 2022 Emerging Trends of State and Local Tax session. During the session, we'll discuss some of the tax policies states have put in place or have introduced that could impact your state and local tax profile in the coming year. So I'm Jim Bartek. I'm a partner in state and local tax and co-market leader of state and local tax practice. Barry?
Hi, I'm Barry Horowitz. I am the co-practice leader with Jim in state and local, and I'm based in the Northeast area.
And Becky?
And my name is Rebecca Stidham. I'm located in our San Francisco office.
And also listed on here is Lejdi McNair, our sales tax lead, who will join us in the next session. Next slide. And next slide. So during this session on the table of contents, Becky, we'll talk about a few things. Obviously, the first thing we're going to talk about is current landscape of state and local tax. And basically here, we're going to talk about the background of how the states are doing throughout the pandemic and how they're doing now. Then we'll discuss some latest development in Nexus for sales tax purposes, including a discussion of Wayfair case, what's happened over the last 3 years and how our companies are dealing with that. Then Becky will discuss some developments on the West Coast, and then Barry will discuss residency issues that many of you are most likely curious about. Now, during this session, please feel free to ask any questions in the forum. If we can't answer them after the session due to timing, we'll get back to you via email in the next few days. So make sure you put those questions in the forum. Keep in mind there's a second SALT session immediately following this presentation that will dive into several issues in more detail, such as pass-through entity taxes, remote workers, some new guidelines from the Multi-State Tax Commission that could affect Nexus on the income tax front, and then also some additional comments on sales tax. Next slide. So which states do you think are the best and worst states rated for business tax climate? Next slide. Well, this hasn't changed much from the past few years. So the top 10 are in blue. So the best state is Wyoming. And second is South Dakota, third is Alaska, and fourth is Florida. Now, Texas is up a few spots to number 11, in case you were wondering. But some factors that make a state good for business include an absence of a major tax. There's always a property tax and unemployment insurance in states, but several states don't have one or more of the major taxes. For example, Wyoming and South Dakota, there's no corporation or individual income tax. Alaska and Florida, there's no individual income tax. And New Hampshire, Oregon, Montana, and Alaska have no sales tax. So some other states in the top 10 may have some of these taxes, but they generally have low rates with broad bases, such as Utah and Indiana. So the worst 10 in gray, rolling in last, I don't know, Barry, if you have a guess on what the last state would be.
There's no question it's New Jersey. I mean, you know, because if tax is not your problem, Jersey shouldn't be your state, right? That's the motto of our re-elected governor now. So
exactly, yeah. So my great state of New Jersey and Barry's is number 50. Close behind is Becky's state of California at 49. New York is at 48, so New York happens to be a little better business climate than California, than Connecticut, 47. In case you're wondering, Massachusetts is at 34. Now, these states tend to have complex, high-rate taxes. New Jersey has some of the highest property taxes burdens in the country, and recently increased to the very high corporate income tax. Inheritance taxes we have here in Jersey, as well as very progressive individual income taxes. So what do you think the largest source of revenue for states are? Next slide. Next slide, there we go. So in 2019, I did look for a chart for 2020. I couldn't find one, but individual income tax heads us up at 41.5%. Keep in mind that includes if you have companies that are structures of partnerships or S corps or so forth, it falls to the individual. But consumption taxes are at 17.6%, sales tax and gasoline taxes, and no, corporate income taxes are only about 3.9% of states' revenues for the year of 2019. Now, states like Florida don't have an individual income tax, rely more heavily on the sales tax. Next slide. Now, the Organization for Economic Cooperation and Development, the OECD, mentions that consumption taxes are the most important tax revenue source for OECD countries. Okay, so it's a significant source of revenue for governments at 32%. Now, you may, other countries, especially in Europe and across the world, generally have a value-add tax, and that value-add tax is a bit different from sales tax, and it's typically taxed at every step of the transaction, and you wind up getting credits as you go. So consumption taxes are obviously different than taxes on labor, like an income tax, which may influence decisions on whether to work or not. There's also tax on savings, of course, an investment, which could reduce productive investment. But taxes on consumption are less likely to influence decisions on work or investment. Of course, these taxes are regressive in nature, the consumption taxes. For example, a wealthy person could pay the same on a sales tax on a car that a middle class or lower class person would pay. So but from a revenue perspective, consumption taxes are generally more stable in downturns and decline less than incomes during the downturns. Next slide. Now, how high are sales taxes in your state? As you can see, sales tax rates are pretty high across the country. Now, one thing I did want to note on sales tax also is that only the final consumption should be taxed for sales tax. Of course, there's some complications such as exemptions in various states, which could be very ambiguous. And they should only be levied on where the good or service is consumed, which there's a lot of confusion on where that is consumed, especially when you're talking about a service. So next slide. Okay, so though this is 2016, you can see several states really rely on the sales tax. Texas and Florida, as you'll note, we mentioned they don't have an income tax, a personal income tax. So they rely heavily on sales tax. Both are around 35% of revenue when it comes to sales tax. New York and New Jersey are 15 and 16%, and California at 20, as you'll see here. Okay, next slide. Now here, how high are the corporate income tax rates in the state? This is as of 2020. So of course, New Jersey, I believe, increased the barrier up to about 11.5 with the restored surtax. And California at 9. And then gray states don't have a corporate income tax here. They may have other taxes, such as gross receipts taxes, but they don't have a corporate income tax. Next slide. Some of the states have gross receipts type tax. Becky will discuss some of the Western states later, but we do see, of course, this list is expected to grow in the future. Next slide. Now, as you can see from this graph from July 2020, the reason we're showing this graph is this was right after the COVID pandemic hit in March. States projected income taxes would fall much sharper than sales taxes and during the pandemic. And as we discussed, sales taxes were more stable. So they expected them to fall less than the personal income taxes and so forth, and the total revenues in general. Now, sales taxes definitely struggled after the initial stay-at-home orders in March and April 2020. But after a sharp drop, sales tax collections increased. It was the 2020 fiscal year, only down about 0.5% nationally. Again, it was due to the they had a very strong last few months of 2019 through February of 2020. Things really slowed down in March during the stay-at-home orders. So the Wayfair case, which we'll talk about in a little bit, and related state laws requiring sales tax collection for out-of-state companies definitely helped during the pandemic. Some of the states did not have those laws in effect at that time, such as Florida. Now, certain states did not do well with sales tax collections. Tourist states like Florida or New York were states that were shut down like New York. So again, this chart was created prior to the recovery. So taxes actually recovered far better than the graphs show. Next slide. So overall, due to the pandemic, and again, this shows fiscal year 19 through fiscal year 20. And fiscal year 20, keep in mind, for most states, ends in June of 2020. Okay, so overall, due to the pandemic, the 2020 state revenues were down quite a bit early at 13%, and that's why you saw a lot of the projections being low. But then they recovered in the last quarter due to close only 5.5% down for fiscal year 20. Okay, and again, a lot of those numbers didn't come out until September of 2020. Individual income taxes did drop 10% year over year, although a lot of that had to do with timing, as a lot of the tax returns were delayed until July and August and so forth. So the sluggish economy also played a role in that as well. But keep in mind, this was after a very strong 2019 and beginning of 2020, so it wasn't as bad as they had thought. That being said, all states were expecting to face a tough road ahead with the COVID unknown. But again, it wound up much better than the estimate. Fiscal year 2021 state budgets were actually up in most of the states. I believe there were only about 6 to 8 states or so that did not have an increase in their budget. Okay, next slide. So let's look at New York to see how they ultimately did after the first year of the pandemic. So the left column is March 2020 year end. That was the actual. Okay, and again, New York's budget ends in March. That's why we're showing this slide. The middle column was a projection of how they thought 2021 was going to go through March 31st, 2021. And then the third, which was about $3 billion less than the prior year, you'll see it goes from 82 billion to 79 billion. And then the third column is the actual through March of 2021, which is only about $500 million less than fiscal year 20. So not nearly as bad as they thought. Now, the 6 months through September 21, the tax collections actually exceeded the budget by $1.8 billion, which is greater than what they thought through the same month the previous year. Now, tax receipts through September were 52 billion. They claim it from higher tax rates for personal income tax, and which is 8.9 billion. I misspoke. It's 13 billion greater than the prior year. So on the personal income tax side, it was 8.9 billion greater than last year, and on sales tax collections were 9.8 billion, which is about $2 billion higher than last year, or 27% increase. So again, this year they're off to a hot start in New York. That being said, as we do know that the New York auditors are back in the field and as aggressive as ever. So next slide. So in this slide, we're going to talk about June only tax collections for Florida, which really is just showing you 1 month of data to show that the difference from the prior year. Now, Florida had a down year last year, but as they rely heavily on the sales tax, and again, tourism was closed down. As I mentioned before, Florida did not have an economic nexus law last year. So they just enacted that effective this year in July, I believe it was. And of course, they reopened this year. So as you can see here, the revenues for the month of June were up quite a bit. So they were up $1 billion to be exact. So, and again, corporate income taxes were up about 321 million. And overall through June year end, revenues were up 15% from the prior year. Okay, next slide. So let's talk about some trends. So what are we expecting states to do? We do expect them to continue broadening of the nexus standards during the coming year. Of course, on the sales tax side, all states, and talk about in a second, all states have generally enacted an economic nexus standard for Wayfair. And of course, we're going to talk more about it in the second section, which is right after this session, the state and local tax session. But the MTC, which is the Multi-State Tax Commission, has issued some guidance on what they feel should be new nexus laws or so forth, new on how the state should be treating income tax nexus. Okay, so basically, again, taxes do matter for business. They create job creation, retention, plant location, competitiveness, as taxes, of course, diminish profits. So they're definitely weighing this as states determine how they're going to enact taxes. But we do expect some rate increases on corporate and individuals. There could be surtaxes. We could see an expansion of tax base, such as foreign income. We've seen that in a couple states. And then, or you could see postponement or suspension of NOLs, which a few states have done throughout the past few years. Combined reporting is also an income tax trend that we see, and then exporting the tax burden. Now, what does that mean? Now, exporting tax burden is basically the jurisdiction imposing tax burdens on residents of another jurisdiction. For example, Florida and Nevada tax tourists with hotel taxes and so forth. New York has Office of Convenience rules and so forth. Okay, next slide.
Jim, just to interject, regarding the tax trends, under the CARES Act, which the Congress passed, a lot of states did not follow CARES Act. So we have a really good bifurcation now between state law and federal law. So people think they might be getting refunds from going back to 2014-15 under the CARES Act. Will not see those refunds for state purposes. They left the bad stuff in the states, but left a lot of the good stuff that potentially for taxpayers. So
exactly, good point, Barry. Thanks for bringing that up. So on the other tax trends, other than income tax, again, we will see the broadening of tax base for sales tax, digital taxes. Many states have digital tax laws or definitions defining digital tax or services. And it's becoming a hindrance to some of our clients. They're very broad definitions. As companies become more technologically capable, and of course, transitioning during the whole pandemic to a more online environment, that caused some issues and some ambiguity in what is actually considered a digital good. Now, I know my home state is actually looking into what the digital economy means for them and what positions they can take potentially, as well as where they can expand the tax base potentially. Of course, I'd mentioned before, you have gross receipts taxes, and Becky will talk about that. Financial transaction taxes, a couple of states have tried to impose this and basically shot down. I'm not sure if any have actually won or enacted that. We could see obviously excise tax on gas, nicotine, or cannabis. CEO pay tax, which I believe there's one or two cities that have enacted that, but you can see that come up. And of course, unclaimed property is something we've been seeing quite a bit. Now, states previously, including Delaware, just went after larger companies. Now we see them sending notices to companies under $1 billion. So many of our clients have received these notices. Please take them seriously. Of course, let us know if you have any questions about them. Next slide. So Wayfair, latest developments in Nexus. Now, one of the ways the states, of course, can make sure they meet their large bloated budgets is to enforce the Nexus statute. So again, as I mentioned before, we do expect the states to start sending out notices. They're getting a lot smarter. We're seeing a lot more of our clients getting questionnaires, Nexus questionnaires from states. And of course, they're starting to get notices, the ones that have audit notices, the ones that actually have registered and started collecting taxes and so forth. So, but while many of our clients have addressed the Nexus issues, many others have not. So we're going to go through some of the Nexus rules here again. So, but keep in mind that even if you have addressed the Nexus rules in the past, the economic Nexus laws may have changed in various states, or you could have had major changes in revenues or new products and services that you're offering. So therefore, we always recommend a review of this periodically, or whenever you do change services, to make sure you're accounting for these changes correctly. Now, some of our clients' revenues have increased as online sales increase, so you may have exceeded the Nexus thresholds. So again, you got to keep this in mind when dealing with your year-end planning and throughout the year. Okay, you can stay on that slide right there. So prior to Wayfair, the Quill decision 1992 was the rule of the land. That was a North Dakota case. basically required some sort of minimum contact with the state. So if you had inventory, people, visits by salespeople, trade shows, or other physical presence in the state, you would have nexus for sales tax purposes. Affiliates could have also caused issues if the out-of-state affiliate was closely tied to the in-state affiliate. For example, in the past, you may have ordered books or items online and from a subsidiary of a company and had the ability to return them back to a brick and mortar store. That would create nexus as well. But one thing I want to point out here is due to remote employees, and again, we'll talk more about remote employees in the next session. But if you have remote employees now, you might have a sales tax nexus. Okay, you might have income tax nexus, but again, we'll talk about that in the second session. Also, Amazon inventory. If you're selling on Amazon or some of the other sites, and you have inventory located in particular locations, just something that you might want to keep in mind to check, because you might have nexus for sales tax purposes. Next slide. Now, what was the Wayfair decision in a nutshell? South Dakota enacted a law requiring collection of sales tax if a company had $100,000 of sales or 200 transactions in the state, basically nullifying the physical presence requirement in the Quill case. Now, Wayfair and several other online retailers challenged the law. The Supreme Court agreed to hear the case, and in June 2018, the Supreme Court ruled in favor of South Dakota versus the online retailer Wayfair, and that's the furniture company, if you're wondering. I believe they sell other things, but furniture is the main good. Now, the majority opinion indicated Quill was flawed and actually created rather than solved market distortions. And what they mean by that is a large company like Amazon or Wayfair could sell into your state and not collect sales tax, but your local stores did collect sales tax. So therefore, they were obviously able to have a competitive advantage. Next slide. Now, keep in mind, people didn't have internet access in 1992 when Quill was decided. So today, over 90% of people do have internet access. So mail order in 1992 was approximately $180 billion. And then in 2019, it was $600 billion. So that was one of the reasons that the states were losing quite a bit of money, billions of dollars in sales tax. And that's why they were pushing so hard on this issue. Next slide. Now, as expected, after the Supreme Court ruling, most states quickly enacted an economic nexus law with thresholds, and it caused a lot of confusion because many services that may not be taxable in your home state may be taxable in another state. For example, in Florida, in California, software as a service is not taxable. However, it is in 25 or so other states, including New York. Plus, many states have increased the number of services subject to tax, such as digital services we talked about before. So next slide. So there are many nuances with economic nexus laws. So I won't go through this in detail, but some states have the word "and" in there, such as New York, which has 500,000 of sales into the state and 100 transactions. So it's conjunctive language, and there's others that use disjunctive language, such as $100,000 of sales or 200 transactions, like New Jersey. Some have reduced their thresholds as well, as I mentioned. So also just did want to mention that many states are getting better at cross-checking to see if you're filing, we mentioned remote employees, if you're filing payroll tax in one jurisdiction, that maybe you should be filing sales tax in those jurisdictions as well. So again, the regular physical nexus laws still apply in the states. Okay, next slide. So who's a remote seller? Everybody could be a remote seller. Tech companies were initially hit pretty hard, sale the software as a service, but many companies became tech companies and didn't even know it. For example, I had a company that was an educational company who originally had just performed in-person sessions and adapted to the market and are now performing services online. And some of those particular seminars could be taxable in various states. So once they cross those thresholds of nexus, they might have nexus and it may be taxable in those jurisdictions. So it's very important to understand that you need to understand your products, and in order to do business in a particular state, you have to understand their laws. Okay, next slide. And again, as I mentioned, every other industries other than technology, media companies, subscriptions or new services, streaming services, selling information services across state borders, advertising services could be taxable if, because New York could assert, or other states could assert it's you're selling some sort of software. Financial services, selling gold, silver, and access to information or soft dollars. Not-for-profits, we've had some clients that are selling outside information outside of their home state. So again, all of this comes up under any due diligence or M&A transactions. Again, something that we are telling our clients to make sure you take a look at. Okay, next slide. Foreign sellers, a lot of ambiguity on whether foreign sellers are subject to the Wayfair case, but basically states are taking a position they are. So inbound companies selling items in the US should definitely look into Nexus. Next slide. And marketplace facilitators. Another reason why the states are in better shape, of course, is they've passed these marketplace facilitator laws that capture sales tax from facilitators like Amazon, Etsy, eBay. Also helped with the state tax collections. But keep in mind that this isn't only limited to Amazon, Etsy, and eBay. We have several clients that are actually qualified for the definition of marketplace facilitator and now have the responsibility to collect sales tax in the jurisdictions and potentially other taxes, which Becky will talk about after. So therefore, while the economic, I did want to stress before I finish up on this, is that the Wayfair case also affected income tax as well. While certain states may have clearly indicated an economic nexus has always been in play for income tax and gross receipts taxes, these states asserted bright line tests for sales, doing business or other activities, of course, licensing intangibles and so forth when determining nexus for income taxes. But this, the Quill case was for sales tax, so the states usually took the position that it did not apply for income tax. That being said, as a Wayfair kind of validated that this was justified, and against why the states are looking at other ways to assert nexus on the income tax side. Okay, so next slide. So with that, let me pass it over to Becky, and she'll talk about the Wild West.
So I'm going to cover a couple of the gross receipts taxes and the changes that we're seeing on the West Coast. And I'm going to start with, though, two changes to California tax law that are most recent. And the first one is going to be the California pass-through entity tax. This is an area where we have seen more than 20 states enact pass-through entity taxes in order to work around the $10,000 state and local tax deduction that was passed with the Tax Cuts and Jobs Act. What this allows a pass-through entity to do is absorb the tax or pay the tax directly. So the tax is actually imposed on the pass-through entity, whether it's a partnership or an S corp. The pass-through entity can then deduct the tax for federal income tax purposes, and that deduction is passed through to the individuals as ordinary, as an ordinary deduction. Therefore, getting around the limitation on a Schedule A for an individual taxpayer. So California enacted this for 2021. It's 9.3% tax on eligible entities. The election is made at the entity level. And partners can elect in or out for California purposes. That's not the case in other states, but California does allow that. In the next session following this, we are going to get into pass-through entity taxes in more details. But specific to California, some of the things that we're seeing that we want to be aware of is whether or not the states that are enacting pass-through entity taxes, if those taxes will be allowed as a credit against resident state taxes. This is something California has not opined on with their pass-through entity tax. However, New York has come out and said that the resident state tax credit is allowed for substantially similar pass-through entity taxes. Another area of concern, or at least that needs to be vetted before making a pass-through entity election tax for California purposes, is whether or not your partners will be able to absorb the credit. So the pass-through entity tax is going to be passed through to the partners' credit. This credit is non-refundable in California and can only be carried forward up to 5 years. Therefore, what we're seeing is some partners will be able to absorb these pass-through entity tax credits within a year or two, but others may not, which makes it pivotal that your partners are doing specific analysis with regard to their tax position to determine whether or not they can absorb this tax. Nothing's going to help them if the tax, the credit that they receive expires and they get no benefit from it in terms of their state and local tax liability. One of the big issues that we're starting to see with regard to pass-through entity tax is a duplicate in the estimate payment requirements. So specific to California, they have come out and said that individuals need to continue to remit their estimated tax payments through 2021. Additionally, last week on November 3rd, California FTB updated their frequently asked questions website to indicate that the 7% non-resident withholding still applies, even if the entity elects the pass-through entity tax. This definitely raises a cash flow concern for entities that are making this election. So it's certainly not something to decide on without proper analysis. The other important thing that we've learned most recently from the FTB is that guaranteed payments will not be part of an entity's qualified net income. So if your entity is guaranteed payment heavy, that will be, there won't be as much of a benefit with regard to the pass-through entity tax in California. Also, just a note, disregarded entities are not considered a qualified entity, nor are they a qualified taxpayer. So a disregarded entity cannot pass through a PTET credit, even if it's an individual owner. So that's something to note. Much more to come on pass-through entity taxes, and we're continuing to monitor the situation in states like California, New York, Massachusetts, and New Jersey, because these are all new and they change very, very quickly. Something else that we've just seen come out of the state of California is with regard to California marketplace facilitators. Now, Jim touched on this briefly in terms of what a marketplace facilitator is, i.e. something like Amazon, but we are seeing other platform clients get pulled into the definition of marketplace facilitator, because really any business who contracts with sellers to facilitate the sale of those sellers' products or services in an open marketplace could be pulled into these definitions. One thing that we have recently seen in California, now I am not personally aware that this has occurred in many states, but California has come out and said that marketplace facilitators are also going to be required to register, collect, and remit for fees under the FCPL. These fees include the lead acid battery fees, the e-waste fees, the tire fees, and the lumber product assessment. So not only are you now collecting and remitting sales tax for sellers on your platform, but you could be held responsible effective 1/1/22 for these other fees that are applicable in California. We've also looked into this a bit for such thing as liquor taxes. So this is something that you definitely need to be aware of if your entity falls into the definition of marketplace facilitator, because we do expect to see the states expand what a marketplace facilitator must collect and remit on behalf of the sellers on their platform. The Oregon CAT is a relatively new tax. It has only been around, this is the second year. So we have seen some movement in terms of, who and what is applicable, or this tax is applicable to. It's more just calling your attention to these next 3 taxes that I'm going to discuss, because the gross receipts taxes are becoming more popular amongst the states. And especially in the states where Jim noted they don't have a high income tax or a high corporate tax. So unique to the Oregon CAT tax is, even if you pay Oregon corporate taxes, the Oregon CAT tax is in addition to your Oregon corporate tax. Entities that have $750,000 of commercial activity are required to register. However, there is an exemption of up to $1 million. So you are only taxable on Oregon commercial activity in excess of that $1 million. This is a tax imposed on the business for the privilege of doing business in Oregon. The state has been questioned on whether or not a business can pass through this tax to their customers. And the answer is you certainly can, but it is then going to be included in the base of the Oregon tax. So it'll be a taxable gross receipt if you try to pass it through. And then you're just in a circular issue with regard to the Oregon CAT. Nevada commerce tax, this one has a very high threshold. It's $4 million. You're not required to register or remit the tax or even file until you hit that $4 million. However, Nevada has been one of those states before where folks have just assumed we can do all the business we want in Nevada and we're not going to be subject to any tax. And Nevada has changed that with their commercial activity tax, which was enacted in 2000, I believe. And the threshold was adjusted by the threshold was adjusted to $4 million last year. You cannot file on a consolidated basis for Nevada purposes. So each entity has to determine its own filing requirement and file its own return if it is subject to the Nevada commerce tax. 2 issues to note about Nevada commerce tax is rental income is subject to the commerce tax. It is not passive income under Nevada statute. And additionally, if you are an independent contractor or you have independent contractors, they could be subject to the commercial activity tax. I'm sorry, the commercial commerce tax in the state of Nevada. So something just to be aware of if you're doing business or you have employees in the state of Nevada. Some recent changes with regard to the New Mexico gross receipts tax as of July 1st, 2021. They did switch to destination-based sourcing. Previously, New Mexico used origin-based sourcing, in which most gross receipts tax was reported at where the seller's business location was. The exception to this is if you meet the definition of professional services. A professional services is any service that requires a license from the state to perform or requires a master's degree or better to perform. Those gross receipts related to professional services are still going to be sourced to the taxpayer's business location rather than destination-based sourcing. New Mexico also updated their compensating tax rules. This is use tax. And now the thresholds, the economic nexus thresholds, and if you have nexus in the state, this applies to their local jurisdictions as well. So if you have compensating use tax filing requirements, it's not only at the state level, but at the local level. Finally, the Washington business occupation tax has been around for a long time. Most companies are aware of this tax. This is just a general reminder. If you have employees in the state of Washington, or if you are making $100,000 or more of sales sourced to the state of Washington, you really need to ensure that your company has looked into whether or not they have a sales tax or business occupation tax obligations in the state of Washington. Washington continues to be incredibly aggressive in terms of what it taxes, who it taxes, and when it taxes them. And they're generally very aggressive under audit. And they we see a lot of audit activity come out of the state of Washington. So while not a new tax, Obviously, economic nexus is relatively new. That threshold applies to both the business and occupation tax and the sales tax. So just be aware, if your company's doing business in the state of Washington, you should certainly be taking a look at your Washington business and occupation tax filing requirements. With that, I'm going to pass this over to Barry.
Yeah, and Barry, just so you got 10 minutes.
You, Jim, and in 10 minutes, I'll talk very quickly about residency. I know I've spoken over the last few years at all the client CP about residency. So Rebecca will start flipping right through these slides or whatever. I want to get up to the section where we talk about that. And again, there's some articles and there's a CBS interview I had on residency and obviously as rates have gone up. So one of the things that, we're talking about is in residency, and we can move on to the next slide, is the escape from New York, New Jersey, Connecticut, and all the other jurisdictions where we've seen a continuous amount of people just moving out. In 2020, during the pandemic, we saw over 130,000 change of addresses as people moved out from New York and down to various jurisdictions. You can see Los Angeles had a huge amount of people moving there. So when we get to the next slide, Rebecca, as we move along quickly here, our Walden's been in the news for other things, but he is certainly on residency, was picked up in New York City. But the question comes up, how do I become a resident of the state? Well, you become a resident of the state very easily. You can walk into a state and say, I want to be a resident. The state will welcome you with open arms. They will say, thank you for being a resident, because all you have to do is you get a driver's license, you get a voter's registration, you have a house there, or renting, owning, or whatever else. States love to bring you in. It's how you get out of the state that you're living in is the big issue here. And Becky and I work in the two biggest states who are the most aggressive in this country, California and New York, with people trying to leave for residency. But there are a lot of other states out here, Massachusetts, Illinois, who go after taxpayers just as fast. One of the most litigious states of all is Utah. There are cases after cases of people trying to move out of Utah. As you can see, a lot of people moving in, going to Park City or whatever else, but we go there. So there are two major areas that we talk about in residency. And the first is domicile. And domicile is the most important thing. You have to break the domicile in the state that you're in. I think, Becky, it's slide number 54 that we want to go to. Okay, let's start with here. Go back, Ricky. So one of the things that we talk about, the residency requirements of states that people are leaving, there is a domicile concept and a statutory residency concept. The domicile concept talks about, many of the states where my heart is, and that's what you have to do. You have to change where your heart is. You just can't say for tax purposes you want to become another resident. It's for domicile purposes that you move out. There's also a statutory residency test in many states, and that basically says if you spend over a certain amount of time in those states, you are automatically a resident. If you have a permanent residence there, which means owning a home, renting, you could have a trailer that's parked there. You could have a boat that's parked there. So California says over 9 months, but many of the eastern states have the 183-day test period, which basically says if you have a permanent place in that state and you are physically in that state 183 days, you are automatically a resident. But you have to win domicile first, and that's where there's always a conflict where people have something with the confusion where they say the statutory residency is the first test. It's the domicile concept that we have to break. And again, we look at the state inheritance taxes when we want to tell people where to move to states, because obviously New York has an onerous estate tax, and obviously that's the big dollars involved. Next slide, Becky. And again, where are people going to? We have the various, retirement community, states, and Nevada obviously is one of the best ones. No income tax, and the domicile concept doesn't there. You just walk into the state of Nevada. I want to be a resident. You're a resident. So why don't we go to slide number 54? Okay. So 54 talks about the two-part determination. So we talk about it in the major states, and especially in the Northeast area, the 14, the STOA states, which go from basically Washington, D.C. and Maryland up to Maine, all have the same basic definition. You're either domiciled, and there are 5 things that we look at in domicile. The next slide, we'll go over that. Or the permanent place of abode, and physically in a state over a certain amount of days automatically makes you a resident. Next slide, Becky. Okay, so this is a basic slide that we put together, you know, on the near and dear items you have to weigh and what we have to do here. Your home, the value of a home, the size of the home, the use of the home. Is it where your family comes to visit you for the holidays? Is it where you use? If you go to everybody else's home, is that really your home? Where your possessions are? So the states look at the size, the value, the nature and use, historical. We always tell clients, you want to move out of a state, downsize if you want to continue to have a home there. Active business involvement, it's always show me the money. Where do you make your money? It's a little hard to run a company if you're sitting in Florida and all the operations in New York. You're a CEO, you're running the company. Through COVID, we've learned how to do that. Previous to COVID, the states would always ask that question. Now, obviously, there's been a whole change in everybody's lifestyle and everybody's thought process. So again, we look at passive involvement, owning, being active or inactive in business, and continued unemployment. If you get a W-2 in a state, a lot of times it's very hard to get out of. Near and dear items, that's a picture of my dog here. Where does the animals live? I can look at my vet bills and see where the animal's getting her service or his service, you know, from the vet or whatever. Where's your jewelry kept? Where's your art and photos? If your main residence is in Florida, let's say, and you're trying to leave New Jersey, okay, your wedding albums, your main family albums should be sitting in Florida, not in New Jersey. So again, we look at near and dear items. Number 4 is the conundrum I deal with a lot of clients. They say, okay, I'll spend 170 days in Florida, 160 days in New Jersey, and I'll be traveling for 30 days. Well, the state looks in and says, if you got more days in New Jersey than Florida, you're still a New Jersey resident. So again, time spent comes in, and especially if we have, you know, clients with 2 or 3 homes. I have one with 6 homes. Where's you send a preponderance of time? And that's something you look at with evidence of diary, living patterns, and third-party documentation. And finally, the family connections. They look at your minor children. Are they going to school in a private school somewhere? Are they boarding school or whatever else? Are they in North Carolina at a boarding school and you live in New York or in Florida? So we look at the primary schools, but again, the scenario the states and the auditors look at is if your minor children are living with you, if they're going to public school in that state or city where you claim you're not a resident of, that does not put a good case for you. So again, we look at location of immediate family, if you're taking care of your parents or whatever else, where they live. So let's go to the next slide, Becky. So that's basically domicile defined.
Barry, 2 minutes. 3 minutes. So
3 minutes. Okay. So additional factors, because domicile I want to concentrate on because that's the main thing. Where's your factors? Where's your mailing address for bills? Where's your safety deposit box rental, vehicle, car registration, driver's license, voter registration, and you voting in that state, not just because you just say you sign in or do a mail-in ballot, telephone services. The most important thing I tell clients, make sure your wills are updated. You want to pass on in the state that you claim you want to be a resident of. You don't want to have your estate being fought over by 2 or 3 jurisdictions, depending upon how many homes you might have. Really important. That's the first thing to do is talk to your estate and trust lawyer before you start. Next slide, Becky. Okay, so it's again, domicile is very subjective. It's where your heart is, and that's what we try to get through. So let's go to the statutory residency test. And again, anytime anybody wants any consultation, we're here to work with you and talk to you. So we talk about now the permanent place of abode, because that's the 183-day test. It's maintained. Is it maintained for you? Do you still have it? You have a former spouse. Do you still own the house? Do you have a friend's apartment you might stay in? Do you have a child's apartment that's paid for by the taxpayers? All these problems lead to problems when you're dealing with the residency auditors. So we talk about making sure you clean those up, get it out of your name, make sure you're not writing the checks, make sure you're not paying for those apartments, because that comes in. Permanent place of abode is usually a year-round place where there's heating, cooking facilities, where you can live it year-round. If it's a hunting shack up in the Adirondacks, let's say, and they have no heat in the wintertime, it may not be a permanent place of a residence here. Place of abode could be anything: house, cooperative, rental apartment, condo. It could be a summer, winter home. As I've had cases with boats, it could be a Winnebago. You drive it, you park it. It could be a trailer. It's parked in a trailer park. So again, there's a lot of things, and we use the word, and you see the keys there. Unfettered access is the main thing. So Becky, let's go to the next, and I think we'll wind up with that. So a day count. This is the key where people get killed. Any part of a day is a day. You don't have to sleep there or whatever else. There's a couple of exceptions. Traveling through a medical recuperation. Travel exceptions, I'll give you a very quick thing. You fly from Florida, you go to New York, you change planes, and you fly out. If you stay within the airport, that is not a New York day, okay? Or you go to Newark, New Jersey to the airport, that is not a New York day. If you go out and want to go shopping, go back to your apartment for 2 or 3 hours, return back to the airport, that is a day in New York State. Again, it's something that people get confused on. We ask clients to keep diaries, credit cards, and the area that people forget about is their cell phones. That is the tracking device that the states use to where you are, because your phone never goes off. Your GPS is always there. It's sitting on. You could have pictures, GPS, emails, text messages, whatever else. So again, this is where the states go after immediately cell phone records there. With that, I think, Jim, at 3:41, we've got some questions, which we'll follow up with everybody there. All of us are available. Our emails, our phone numbers are there. And with that, thank you very much. And hopefully you've got some information on state and local taxes from the group. Thank you. Bye-bye.
Thank you, everybody.